Hello and welcome to Bondcast, our podcast series where we discuss the latest themes and events shaping rates markets. I'm Joann Spadigam, European rate strategist, and I'm joined today by our global market specialists, Cummins and Ian Vanderhorn. So it's been a pretty busy week, I would say, in the US markets with a load of data coming, trade deals, as well as the Fed meeting, of course. I think let's start there. Kevin, we've had the Fed meeting now with a no change scenario. How are you seeing the meeting from this week and also our Fed view for the rest of the year?
Well, thanks for having me. As far as relative to our expectations, I think we weren't really all that surprised with the outcome of the Fed meeting. All the information that we got, not just that. Obviously, the decision was virtually a lock for no change in yesterday's meeting on interest rates, but the press conference as well as the changes to the statement were very much in line with what we thought coming in. Obviously, there was no change in rates, and we got kind of a double dissent, both from Waller, Fed Governor Waller, who really signaled that he was going to be in favor of a 25 basis point cut, and as well as Bowman, who said she could go along with a view that they should be cutting rates. So typically, a dissent is pretty meaningful from the perspective if it's a governor. We haven't seen this since 1993. But all meetings and all backdrops and cycles are very different. So you can't really compare it to then. And in fact, back in 93, they were arguing for a more hawkish dissent. So this was obviously a more dovish dissent. But nevertheless, they were dissenting on the meeting. Now, you could question whether or not the motivation for dissenting, you know, like, for example, Fed Governor Waller is on the short list to become chair. So, there may be other motives there, but I'll stop there and just go along with the idea that he's worried more about the labor situation in the U.S. and kind of wants to get back towards a less restrictive stance and policy. When asked about the dissents in Chair Powell's press conference, he very much, he stated that they have differences of opinion, but they were, the two of dissents were in that camp arguing for a rate cut, and that they'd be issuing a statement after probably on Thursday or Friday. So. From that perspective, very much as expected. Then the statement itself, the changes to the statement, there too, they were very modest. They were a little more dovish than the previous statement in that they marked down their characterization on economic activity from solid to moderate. Prior to the meeting, the GDP report for the second quarter came in line with our expectation of 3%. But it was also the details which we were emphasizing that we were going to see a slowing in domestic demand, particularly if you look at personal consumption expenditures and business fixed investment and look at real final sales to domestic purchasers. So I do think that all the uncertainty that was that we've seen so far this year, uncertainty around tariffs, have started to slow the overall growth path. Not to the extent that the economy is slipping into a recession, but it's certainly a step down from where you were. And Powell made reference to this in his press conference, and the statement itself reflected that, saying in the first half of the year, growth has moderated. Outside of that, there was a slight refinement relative to June with regard to elevated levels of uncertainty, but I think it's just more mark to market of where we are rather than a signal of how the market should be interpreting something from that. So initially I think it wasn't really all that much different. As far as the press conference, I think some were surprised that Powell spent as much time as he did kind of defending where the current stance of policy is. and how they're modestly restrictive. He pointed out that the labor market right now is in or at full employment with the unemployment rate at 4.1%, but that they're missing on their inflation profile and their inflation side of the mandate. It's running a little bit above their 2% objective. And if anything, there's risk to the upside given the uncertainty around tariffs and how much of an impact that's going to have. He did acknowledge that it has already started to impact core goods. Outside of that, though, even if you take out X tariffs, he said that inflation is still modestly above their 2% objectives. And he pointed out that when we're at this crossroads where if there's downside risk to the labor market as well as above average inflation, then they're going to look at the mandate of which is more out of whack. And right now, that's the inflation data are what they're worried about. In fact, he was asked about September, and I think this is the big question that everybody was curious about going into the meeting, and he really didn't do that. And as far as this week's data, we got a whole wide variety of data from yesterday's GDP report. And if anything, it wasn't all that surprising. We do think the economy's shifting to a lower growth rate. But that said, given that we saw so much of a drag in inventory growth in the second quarter, and then I'd leave you with one last thing that Powell talked about. That was, I think he raised the bar a little bit about what it's going to take for payrolls before the Fed gets really worried and has to cut rates. And he brought up the idea that it's the unemployment rate that really drives Fed policy, not so much payrolls. He brought up the idea that labor demand is slowing, but so too is labor supply. So the implication is if you get which we've seen already, cooling in labor demand at the same time, while given the immigration policy that we have in the U.S. and that's likely to be a drag on the labor supply. The break-even rate is probably moving lower, and you could probably get something in the magnitude of weaker payroll growth. And what we've seen over the course of the past year is the unemployment rate has virtually remained steady at 4.2% in a very narrow band of say 4 to 4.25. And as long as the unemployment rate is hovering near full employment, from the Fed's perspective, they're going to focus on making sure that inflation returns back down to 2%. So, we could be setting up for perhaps weaker than expected job growth in payrolls. But if the unemployment rate doesn't move up higher, then the Fed may not be as worried as those potentially worrisome payroll numbers could be.
Thanks, Kevin. Let's turn to you, Ian. I think aside from the Fed, there's obviously been some focus on the QRA this week. We did get a pretty hefty financing number, all things considered, but I think there's obviously been much more focus on what it means for coupon sizes and buybacks. So what's your take here, and how does this square with your view on where the curve should be in the US?
Yeah, well, thank you for having me, Joann, and I think Kev did a really nice job of squaring up the FOMC meeting. But the QRA, the quarterly refunding announcement, was released on the same day as the Fed, and you sort of alluded to the two parts of the QRA. The first of which is the issuance announcement, or how much the Treasury expects to borrow in the coming quarter. And like you said, that was a very, very hefty number. They expect to borrow about $1 trillion between July and September. But I do just have to, emphasize the asterisk next to that number, which is that about half of that, or at least a very hefty chunk, will be going towards rebuilding the Treasury's general account, which is essentially their checking account at the Fed. And that had been run down under the debt ceiling, which of course was just lifted in July by $5 billion with the passage of the tax and budget bill. So the first part of the QRA, like you said, a very hefty issuance number, but a good portion of that is just going to the Treasury rebuilding its normal operating cash balances, which in this instance they set as a target of $850 billion for both the end of September and the end of the year. That's a little bit high, maybe a little bit higher than the $800 billion perhaps than we had expected, but nothing really to read too much into. And then, like you said, the second part of the QRA, which was announced yesterday and is arguably the most important part, is the issuance plan. So with respect to that, it really came in mostly as markets expected. Treasury did not change their coupon issuance in the coming quarter, and they reiterated their guidance that they do not expect coupon issuance to change for at least the next several quarters. So what that does, it definitely solidifies coupon issuance, in our view, at least through 2026, as being stable at the least. The other thing they did was, with respect to bills, they said that they expect bill sizes to increase a little bit more in the coming days, actually, but then stay steady for the most part until increases again in October. So if we do get increases in the bill sizes, particularly in the 4-week and the 8-week bill in the coming days, that would bring those bill sizes to all-time highs. Not surprising again, but we would be looking at about $100 billion in terms of the 4-week bill, which is quite hefty. These two things taken together, if we're talking stable coupon issuance and then a preference to continue to increase bill sizes, it really sort of informs our outlook for what issuance is going to look like, not just through the rest of 2025, but for 2026 also. And over the last quarter, given guidance from the Treasury, we've really made a significant change to our expectation. We now see coupon sizes remaining stable for all of 2026, and we expect bill sizes to continue to ramp up, not just through the end of this year, but through 2026 as well. So we see bills actually, especially with respect to the front end, so the 4-week and the 8-week issue, ramping up as much as 30% through the end of 2026, all while we expect coupon sizes to remain stable. It seems like a very high amount, potentially unstable amount for markets to digest, but I will just flag one thing, which is that bills as a percentage of outstanding marketable debt, which is a metric that the Treasury uses to look at when it's considering its bill issuance, under this trajectory will only reach about 22.5%, which is actually in line with the peak of last year. So not too alarming. The other part of the refunding announcement, which you also touched on briefly and was probably more important yesterday, was with respect to changes to the buyback program. These were anticipated, at least to some extent. We certainly did anticipate them, but the change that was made were increases to the Treasury's buyback program in the long end of the curve. Specifically, they run two types of buyback programs. They run a cash management buyback program, which is done quarterly. It comes around heavy tax inflow dates, so 4 times a year, and they'll buy back mostly in the front end of the curve, so between 1 month and 2 years. And the other buyback program is called liquidity support, and that's done across the curve. And in this instance, the more, impactful change was that Treasury announced that they would be doubling the frequency of the program when it comes to the 10 to 20 year bucket and the 20 to 30 year bucket. So it will increase buybacks in that part of the curve by about $8 billion in the coming quarter. So it's pretty meaningful there. They did also announce an increase to those cash management buybacks, which I mentioned, coming in the coming year. But importantly, at the same time that they did that, they said that they also wouldn't be running that program in September, this September, when normally they would be running it as corporate taxes come in, and they would instead be starting it up in December. Just important to think about, they're not doing it because they are rebuilding their general account, but those buybacks in the front end of the curve are not going to happen in September until they resume in December. So if I can just take all of these things together, I think the balance of the QRA was that it really confirmed what we thought would be a flattening bias going into this announcement. Here we have continued issuance in the front end, especially a juicing of the bills, if you will, and a lack of September buybacks in the 0 to 2-year sector. While at the same time, we have an expansion of the buyback program in the long end of the curve. So this is Treasury clearly saying there's been a lot of demand for these buybacks in the long end of the curve. We want to support particularly the 10-year point. We've heard that from Secretary Bessent and others. So we're going to build out our program in that part of the curve. Those three things really together do support the flattening bias both into the meeting and out of it. And indeed, as we look forward to coming quarters, we even think that they could potentially increase the sizes of these buybacks further out the curve even more. So between that and, like I said, what Kevin said was a little bit of a hawkish edge to the Fed meeting in which Chair Powell really didn't open the door too much, if at all, for a September move. We were looking at a flattening bias going into both events, and coming out of it, we're feeling very comfortable with the same. And we do think the flattening on the curve that we've gotten over the last 2 weeks has scope to continue, particularly as we look to price out more in terms of Fed easing, and we look to expect potentially more support from the Treasury in the coming quarters, both in the form of no coupon issuance increases and potentially an expansion to the long end buyback program again. So let me just switch gears here a little bit, because over last weekend, we did have a trade deal announced, or at least the framework of a trade deal announced between the US and EU. And we're looking at about 15% tariffs for the EU. I'll ask you, Joann, did this have much of a market reaction this week?
So as you said, Ian, I think there's been obviously some expectation of this 15% tariff in the EU. We had quite a few headlines over the last week that suggested that we would be getting to this place. So I think when that deal was finally made over the last weekend, the market reaction on Monday was fairly muted, because I think this was essentially in the price. But I think what's interesting to me is really what this means for the ECB's reaction function. If we circle back to last week's ECB meeting, to me, the key reason why the policy statement had not upgraded the growth expectation in the euro area, so shifted from downside growth risk to more balanced growth risk, was the fact that there still was, at that point, significant uncertainty on what trade would look like going forward. So I think this resolution on trade does help quite a lot in terms of actually understanding what the impact of growth will be, or on growth will be, from the tariff, and also considering the positive in the pipeline that we've mentioned before, which is really fiscal policy. So I think net, the fact that we have a deal on the table is helpful for consumers in the euro area, for businesses in the euro area, and for the ECB ultimately, in terms of understanding how to proceed in terms of thinking about their forecast for the next meeting in September, and perhaps shifting that slightly negative bias, I would say, on growth that they did have in the statement. I think aside from the statement, if we looked or remembered the policy, the press conference from last week, Lagarde was pretty positive on growth overall. So I do think that narrative of a more positive picture for European growth can be one that has legs in the many, many weeks and months to come. The second thing is that we did have some ECB sources that pushed back a little bit on market pricing and the market reaction to last week. I think it's pretty clear that the ECB would like to have optionality. Of course, I think with any central bank, they're data dependent. They see what happens in the pipeline before making a decision. So some optionality, I think, is ideal for the central bank. But I do think that, all things considered, the ECB does seem to be guiding quite strongly towards this idea that they won't be cutting rates further, and that 2% is really where terminal rates will land. So I think that our base case for 2% remains very much intact, whilst 15% tariffs is obviously worse than what we had at the start of the year. Net, the impact on growth shouldn't be too large, given the fiscal policy positives that will come going forward, with the German stimulus package on infrastructure and defense quite clearly a positive.
So then let me ask you about the curve, because curves have seen some flattening over the last couple of weeks. I mentioned we've had it here in the US, but just wondering, what have you made of this shift in dynamic?
I think firstly, on the front end, we're pretty much pinned down by the ECB reaction function, and 2% essentially there. I think that at the very margin, we could see that repricing a little bit. We've got 12 basis points still priced in for the year. So the 2-year point of the curve, for example, could lead some flattening pressure as markets reprice that. I don't necessarily think there's an immediate trigger for that repricing until the September meeting. So again, I think that 2-year rates will be pretty range bound at this point in time, and eventually we will get some repricing of the front end here. I think the more broad question zooming out is, given the front end is pinned, where do we think the long end risks are? I think that that's the key consideration here, because it will be, in my mind, the long end that's driving the curve. And I think it's quite difficult for me to see a reason why long end should be rallying significantly. One of the narratives, of course, that people have been discussing over the many months since Liberation Day is this idea that we could get a rebalancing in European demand, or demand for EGBs, for example, because of the idea that essentially capital starts leaving the US. I think that's much more of a long-term issue versus a short-term issue. Ian and Stuart, you guys have also been stating that the auctions in the US look pretty decent. We've had a good one this week, as well as the idea that TIX data has not shown a big outflow out of the US. So I think this is a much more of a long-term, gradual grinding away from the US into European assets, if there is one. And I think that on the other side of that discussion, on the supply side, there's still a very hefty supply picture to come. We've got German supply, which is clearly on the upside, and a quite broad global theme that suggests that supply is coming in quite heavily across, the UK, the US, and the euro area. So I think for me in the euro area, that curve steepener view, especially in the long end, does make lots of sense. And I think to tie that discussion up, there's obviously a more structural story in the long end with Dutch pension funds shifting away from the long end, and that is a demand story that is shrinking. Shrinking in demand for duration, which will clearly impact long end rates. And quite similarly, ECB QT once again has taken out that big buyer for long end rates. So I think I'll stop there on Europe. I think before we wrap up this podcast, just a reminder to our listeners that we did cover the Bank of England at last week's podcast with a 25 basis point cut, essentially pretty well priced for next week, and that's of course our expectation. We think the vote split will obviously be quite important, and we do expect a 9-0 vote split for the cut next week. And we expect the Bank of England to remain a gradual approach to easing, so a quarter by quarter approach to cutting rates, with our next cut for November, and that really marking the end of the cycle. But you can listen back to last week's episode of Bondcast to catch Paul's thoughts on the Bank of England next week as well. That's it from us. Thank you to Ian and Kevin for joining me today, and to our listeners for listening. We will speak again next week. If you like this week's episode, don't forget to like and subscribe as well.